So my next guest reminds investors that when it comes to equity markets, there is a seller for every buyer. Remember that, right? Macro trends actually explains that 70% of stock movements. You have to understand what the macro backdrop is because that's what's driving the market. Now, by the way, he's also ranked #1 portfolio strategist last year. So let's bring in Piper Sandler, their chief investment strategist, Michael Kantrowitz. First of all, congratulations. I hadn't seen you in studio in a while. How you been?
Hey, good. Good to see you, Charles. Thank you.
One thing I love about your reports, they always have these amazing charts, right? You give people some great weekend reading, and sometimes they can be intimidating, but not this one, not for me, right? #1 positioning for 2025, embrace mid-cycle factors, not early ones. So walk us through what that means.
Yeah. So some of the data we're starting to see improve are some of these early cyclical signs, like small business data, which we saw today from the NFIB. We're starting to see manufacturing PMIs, which have been depressed for 2 years, start to improve as well, which is not surprising given that we're starting to see the benefits of lower rates. So usually that's a very good backdrop for equities. But usually investors are not as focused on interest rates and inflation as they are today, and that's why I think we're seeing markets struggle with higher yields despite better data.
So soft landing, no landing, hard landing, you're still in a soft landing camp?
Yeah, I think the worst is behind us for the normalization or the softening of employment. Obviously, if rates keep rising, that perhaps creates new risks. But we're starting to see some green shoots. Again, like that small business data, manufacturing PMIs, that should lead to some better earnings breadth.
And those were areas that were depressed. Certainly, to your point, manufacturing for 2 years is like, I keep saying, where's the manufacturing renaissance? Although the jobs report still was disappointed with the losing manufacturing jobs. You in your note, though, highlight the 2 most important risk factors right now. Obviously, higher rates at the top of the list. I don't know you can have a conversation with anyone about the markets right now, about financial markets, without this being the first part of the conversation.
Yeah. I think, if you look back throughout history, the S&P has had a 10% correction 27 times since 1960. The vast majority of them are not recessions, unemployment rate, or growth scares. They're higher interest rates. And so that's what we saw in 2022. We saw that right before the Powell pivot in 2018. And in the summer of 23, those have been the 3 corrections we've seen. And so I think for the foreseeable future, market risks are more about higher interest rates than growth weakness.
But there's a reason for higher interest rates, and it feels like in the past, to your point, there was almost a conventional wisdom or a unified thought of what was driving it. Now, there's a lot of different theories out there.
Yeah.
I mean, there are theories on what Trump may do when he's inaugurated with tariffs, deportations. There's also theories about, there's all kinds of different theories out there, and it feels like it's interesting to me that rates are reacting to these things.
Well, there's theories and then there's data. And, theories, it's hard to deny them or debunk them, and that's fair. The data that bottomed in the middle of September, which coincided with that Fed rate cut of 50 basis points, is that the employment data in the U.S., after that growth scare in August, which probably caused the Fed to cut 50, we saw employment every data point. Claims kept coming in lower. Unemployment started coming down. And last week, had a bounce. So employment surprises in the U.S. are at a 7-month high, and that's probably the most important data that the Fed and investors are following right now.
What about a lack of confidence in the Fed to that point? Because, and again, listen, Powell, he said, listen, we're inflation's okay. We're going to be zeroed in on labor. All of a sudden, they had to make a quick 180 on that. Is there any of this a lack of confidence in Jay Powell?
I don't think I think it's a recognition that there's a lot of uncertainty. Then they're data dependent, which I think kind of reflects that. And if we look at interest rates right now, people are really focused on it. The last time they were this focused on it were back in April, and before that in late 23. I think we're seeing a lot. People are trying to understand why we're getting these 5-month moves where rates go up and then they go down for 5 months. And I think we're in a very reflexive environment.
In the U.S. dollar versus emerging market currencies, we talk about that a lot. I got a minute to go, and I just want to talk about, you went over the sales model and different variables. There's a lot of factors in there, but it was interesting, 4% stocks have a sell rating. It's hard to get a sell rating on a stock on Wall Street. Yeah. And I think a lot of times by the time they go to sell, it might be a buy, but that's beside the point. A lot of folks watching this show, they're saddled with stocks that they've been with a long time, and they have no clue or idea, how do I let this stock go? Now, some of it's ego, some of it's pride and ego, but some of it is like a legitimate, if I knew which one had the least amount of upside potential, is there like a simpler way of going through something like that?
Well, I'd say right now, I think interest rates are driving the equity market. So I think you want to approach it from a macro perspective. If the economy in the U.S. is going to stay pretty healthy and unemployment has peaked, rates are going to probably stay roughly where they are with some volatility. So if there's stocks you've owned for the last 2 years, let's take small caps, for example.
Right.
That have gone up really heavily on the idea that rates are going to come down and the Fed's going to cut 10 times or 7 times.
Right.
That's the stuff that's getting hit now and may really struggle this year if anything that, whether it's tariffs or inflation or stronger growth, keeps interest rates elevated.
All right, great stuff. Great seeing you. Happy New Year.
You too,
Appreciate
Charles.
it.